Module 5 Dividend Analysis and Stock Valuation. Analyzing dividends involves evaluating key metrics such as dividend yield, dividend growth rate, and dividend payout ratio. These metrics provide insights into the attractiveness, sustainability, and financial health of a company's dividend policy. Here's an overview of each metric. Dividend yield. The dividend yield represents the annual dividend payout per share divided by the stock's current market price. It is expressed as a percentage. Dividend yield helps investors assess the income-generating potential of a stock relative to its price. A higher dividend yield indicates a higher income return on investment. However, a high yield may also suggest increased risk or an undervalued stock. It's important to compare the dividend yield with industry peers and the stock's historical yield to gauge its relative attractiveness. Dividend growth rate. The dividend growth rate measures the annualized percentage increase in a company's dividend payments over a specific period. It indicates the rate at which a company is increasing its dividend over time. Dividend growth rate is an important consideration for investors seeking not only current income but also the potential for increasing income in the future. Companies that consistently raise their dividends at a healthy rate may indicate financial strength and positive future prospects. Analyzing a company's historical dividend growth rate, as well as its ability to sustain or increase that rate, is crucial for dividend growth investors. Dividend payout ratio. The dividend payout ratio represents the proportion of a company's earnings that are paid out as dividends to shareholders. It is calculated by dividing the annual dividends per share by earnings per share. The payout ratio indicates the portion of earnings a company allocates to dividends and the retained earnings for reinvestment. A low payout ratio suggests that a company retains a larger portion of its earnings for growth opportunities, while a high payout ratio indicates a significant portion of earnings is distributed as dividends. It's important to assess the payout ratio in relation to the company's industry peers. Historical trends, and its ability to sustain or increase dividends over time. When analyzing dividends, it's essential to consider other factors alongside these metrics. Assessing a company's financial health, cash flow generation, profitability, and future growth prospects helps determine the sustainability and reliability of its dividend policy. Additionally, understanding the company's industry dynamics, competitive positioning, and management's track record in capital allocation is crucial for making informed dividend-related investment decisions. It's worth noting that dividend analysis should not be conducted in isolation but as part of a comprehensive evaluation of a company's overall fundamentals and suitability as an investment. Consulting with a financial advisor or investment professional can provide further insights and guidance in analyzing dividends and incorporating them into your investment strategy. The relationship between stock price and dividend yield is inverse. As the stock price increases, the dividend yield decreases, and vice versa. This inverse relationship occurs because the dividend yield is calculated by dividing the annual dividend per share by the stock price. To evaluate if a stock is undervalued or overvalued based on its dividend yield, you can compare it to historical levels, industry averages, and the yield of comparable companies. Here are some key considerations. Historical comparison. Compare the current dividend yield of a stock to its historical average. If the current yield is significantly higher than the historical average, it could suggest that the stock is undervalued. Conversely, if the current yield is lower than the historical average, it may indicate that the stock is overvalued. However, it's essential to analyze other factors as well and not rely solely on historical comparisons. Industry comparison. Compare the dividend yield of the stock to the average dividend yield of companies in the same industry. If the stock's dividend yield is higher than the industry average, it could indicate that the stock is undervalued relative to its peers. Conversely, if the dividend yield is lower than the industry average, it may suggest that the stock is overvalued or that the market has higher expectations for the company's growth potential. Comparable companies. Compare the dividend yield of the stock to similar companies in terms of size, business model, and financial performance. This allows for a more specific assessment of the stock's valuation relative to its peers. If the stock has a higher dividend yield compared to similar companies, it might indicate that it is undervalued. Conversely, if the dividend yield is lower than comparable companies, it may suggest that the stock is overvalued. While evaluating a stock's valuation based on dividend yield, It's important to consider other fundamental factors such as earnings growth, cash flow generation, profitability, and the company's overall financial health. Dividend yield alone should not be the sole determinant of whether a stock is undervalued or overvalued. Additionally, it's crucial to conduct a comprehensive analysis using various valuation methods, including price-to-earnings, P/E ratio, price-to-book, P/B ratio, and discounted cash flow, DCF analysis, among others. These methods help provide a more holistic view of a stock's valuation and whether it is trading at a reasonable price relative to its intrinsic value. Remember that stock valuation is a complex process, and it's advisable to consult with a financial advisor or investment professional who can provide personalized guidance and analysis based on your specific investment objectives and risk tolerance. Valuation methods specific to income stocks, such as dividend discount models, DDM, and discounted cash flow, DCF, analysis, can provide insights into the intrinsic value of a stock based on its income-generating potential. Here's an overview of these valuation methods. Dividend discount model, DDM. The dividend discount model, DDM, is a valuation method that calculates the intrinsic value of a stock by estimating the present value of its future dividend payments. The DDM assumes that the value of a stock is the sum of all its expected future dividends, discounted to their present value using an appropriate discount rate. The model takes into account the expected dividend growth rate and the required rate of return for the investor. The basic formula for the dividend discount model is intrinsic value equals D/R/G, where D is the expected dividend for the next period, R is the required rate of return or discount rate, G is the expected dividend growth rate. The DDM is particularly useful for income-focused investors who prioritize dividend income. It provides an estimation of a stock's value based on its future dividend payments. However, it's important to note that the accuracy of the DDM relies heavily on the accuracy of the inputs, such as the dividend growth rate and discount rate assumptions. Discounted cash flow, DCF, analysis. Discounted cash flow, DCF, analysis is a valuation method that calculates the intrinsic value of a stock by estimating the present value of its future cash flows. While the DDM focuses specifically on dividends, DCF analysis takes into account all cash flows generated by the company, including dividends, capital expenditures, and potential future cash flows from growth projects. The DCF analysis involves projecting future cash flows of the company, discounting those cash flows to their present value using an appropriate discount rate, usually the company's weighted average cost of capital, and then summing them to determine the intrinsic value of the stock. This approach provides a more comprehensive assessment of a company's overall value and considers both dividend income and potential capital appreciation. DCF analysis allows for flexibility in incorporating different growth scenarios and cash flow assumptions. However, it requires accurate projections and assumptions, and the valuation is sensitive to changes in the discount rate and cash flow estimates. Both the DDM and DCF analysis are widely used valuation methods for income stocks. However, it's important to remember that these models rely on assumptions and projections, and their accuracy depends on the quality of the inputs and the investor's ability to forecast future cash flows and growth rates accurately. When utilizing these valuation methods, it's advisable to consider multiple approaches and compare the results with other valuation metrics, such as price-to-earnings, P/E ratio, price-to-sales, P/S ratio, and industry benchmarks. Additionally, consulting with a financial advisor or investment professional can provide further guidance in applying these valuation methods and incorporating them into your investment decision-making process.